I'm going to bring in our special guest, David Keller. David, you were with us a couple months ago. The S&P 500 was just kind of languishing. It's still languishing. What do you got for us?
Thanks so much, Tom. I as always, enjoy watching your recaps, hearing you talk through things. It's interesting with the markets. I've always told people that remember, the market can go three directions. It can go up, it can go down, it can go sideways. And we love to simplify by thinking up versus down and bull versus bear and bullish versus bearish and all of that. But in the end, a lot of times markets don't go anywhere overall, even when they have elevated volatility. So you have a situation right now where the markets, even with the movement, even with the volatility, have essentially gone nowhere. They've been sideways. And that can be okay because if you're looking at groups or sectors or individual stocks, there are lots of opportunities to differentiate. And I think if you do active management, if you're stock picking, then I would argue that this is a better environment than we've seen in a long time because there are stocks such as some of the ones that you highlighted that are seeing new highs. There are stocks that are seeing new lows, and so there's opportunity.
Yeah, no doubt about that. I mean, we've seen some of it, and I don't know if you're planning to get into it, but maybe at some point later we can. But certainly we've seen a lot of strength in the dollar, and maybe that's funneling some money towards small caps and so forth. But we're going to talk about that a little bit later in the program. I want you to go through and highlight your presentation first. And by the way, anyone out there listening, if you got questions, type them in the chat box. Aaron's going to be monitoring that chat area, and we'll pass your questions along to David as we go through the presentation.
Indeed.
Sounds good. Thanks, guys. So everyone, a pleasure to join you again, and very good to be back. Last time we talked about the different, functions or the different qualities of technical analysis. They can be predictive, they can be comparative, they can be descriptive, depending on how you use technical analysis. Here, I wanted to dig in a little bit more into some of the behavioral reasons why charts work. And what you'll find if you follow any of my blog posts or my research is that I only tend to use technical approaches that I feel have a good backing in behavioral finance, meaning the behavior of investors making buy and sell decisions, and a lot of times making poor decisions with their investments. A lot of times is what creates the patterns that so many of us have found profitable over time. So I like to use things where I find that the validation is in the theory of investor behavior. Before I get to some examples, and we're going to talk about herding today, which is when we all sort of group into one investment position. I just wanted to remind you, I guess, for the positive side, my background, and for the negative side, my background. On the positive side, this is what I've done up until now. I've recently launched an independent research firm using technical and behavioral analysis and data visualization. Previously, I was at a large money management firm in the Boston area, and before that, in a market data firm based in New York. If you look, and I know most of us here are chart users, unfortunately, there seems to be some sort of high correlation between me starting a new professional venture and the market entering into a cyclical downtrend. We've not seen that yet, but if we do see that over the next couple of years, you can come back and either thank me or curse me for providing that catalyst for you. But it's interesting, just as a quick comment, Tom, you had some interesting points about 10-year yields and sort of that sea change we're seeing where, you've seen higher yields now. I'd point out, this is something I've talked with a lot of my peers with over time, unless you were born before 1960, you've seen nothing in your investment career but a falling rate environment. You've seen a bull market in bonds, and that's all we've all known, which means that most of us in the markets now have never dealt with a bear market in bonds and never dealt with a rising rate environment. I thought about it in my previous role, at Fidelity, looking at any of our new associates. So anyone that's started trading or investing since 2010, you would say, has known nothing but a cyclical bull market. So again, all that means is when something happens and when we have a change in regime and when we have dramatic new leadership, for example, if the FANG trade would completely unwind and small and micro caps lead for the next couple of years, there are going to be a lot of people that are very much caught unaware and unprepared for it, which is why I think charts in a lot of ways are sort of the truth serum for the market. That's what will help you stay on the right side of some of those upcoming changes. So I wanted to talk about herding. And herding, if you're not familiar, it's a behavioral phenomenon where we love to pile into one side of a trade. And a market event happens, a news event, even just a simple move in a market, and so many of us react to it. And if we all react in the same way, we're going to create and propel and perpetuate a phenomenon that you see on the charts. Now, there's ways that this happens in the financial markets and happens with individual stocks, but you'll find it also happens with how you manage your day-to-day life. And I'll share an example using social media. So I was never allowed to use Twitter on the institutional side. We weren't able to for compliance reasons. But since launching my own firm, and really even before that, I started getting more into social media. Started using Twitter. So I've been on Twitter for probably just over a year now. You can see on the left there, I've built a modest following, putting out comments on behavior and the markets and so forth. What happens though when you use Twitter, for those of you that you do, is every time that you like something or that you follow someone, what you're doing is sort of curating your own feed. And so if I start to follow people that look at charts in a similar way that I do, if I follow people that are trend followers and that are more long-term versus short-term, as an example, my feed will be filled more and more with people that think and behave a lot like me. And the problem with that is if you're trying to break away from your own behavioral biases and get out of a bad or negative pattern, it's a difficult thing to do if all you're surrounded with are opinions that sort of validate your own. It opens us up to all sorts of problems. Now, if you think about it, other social networks have a similar issue. So on Facebook, your friends that you link up with, you tend to see opinions that are similar to your own. And we've seen that obviously with political ramifications recently. On LinkedIn, your network and the more that you see and hear from them sort of in some ways defines your worldview. So what I would remind all of you is, as we get into herding and the challenges of everyone having the same investment opinion and putting in bets as a result of that, is you really want to find ways to look at opinions different from your own. So if you're a technical trader in your short term, I would encourage you, number one, to talk to long-term investors, because they're ones that are looking with such a different time frame. Their perspective is going to be very different, and your short-term movements could fit into a much larger context in a way you're not prepared for. If you're very technically oriented, I would talk to people who are not technically oriented, people who trade on some other form of analysis. If you are a long-term investor, talk to people who are fundamentally oriented that don't use a lot of charts. And in my career, I've surrounded myself with those types of investors very regularly. And what it does is it's a reality check on some of the conclusions that you're going to make, and helps you understand how others are coming to their investment decisions. Now, if you look at a chart, I'll show you what herding actually looks like. And again, herding is when we all think of a herd of cattle, all sort of going in one direction. What happens when we all have similar opinions, we all put a similar bet on, we are all on one side of the trade. And if you've ever used an indicator like RSI, looking at momentum, you were essentially getting a read on herding by using that indicator. So when the RSI is overbought, or generally speaking above 70, you can assume that people are moving too heavily on one side. That's why we'd say it's overbought, where people are too aggressively on one side of that market. And as many of you know, just looking at this chart of Interactive Corp, most of the time when the stock becomes overbought, it soon after starts to correct, because the market doesn't go vertical for very long, because eventually people start to take profits, and so forth. On the other side, what we saw recently with IAC is when it sold off due to a corporate event, you saw the stock come down to its 200-day moving average. You saw the RSI become oversold, and we would assume that that's hurting on the downside. People have become very negative on the stock, have sold, and a lot of supply enters the market. The stock sells off, but soon after you see that buyers come into the market. So herding will show itself, and an indicator like RSI, some sort of momentum indicator, and there are others out there, of course, but this is one that I've used the most. You will find when there is herding in play. So in your own investing, and when you're looking at charts, herding does not have to be a bad thing, right? So if everyone is going to one side of the trade and you can be aware of that and capitalize on it, now we're doing pretty good work. So in this example, when I saw IAC sell off, and again, we're in earnings season, you saw this with a lot of different charts, but it pulled back to the 200-day. It was oversold. you'll see that third candle when you hit the 200-day is sort of a hammer-like candle with a much longer lower shadow than upper shadow, suggesting that there was accumulation during the trading day. Those sort of things combine to tell me that this was a little too far too quick, and it might be a good opportunity to jump in on weakness on the chart. Now, the last time I was in, which was a couple months ago, I believe, we looked at this slide, which I had a number of questions on. So I just wanted to review it with you because I think it's a really good lesson on what technical indicators you want to have in your own toolkit. So I think of the market in a couple different time frames. We have the short-term time frame, medium-term, and long-term. So the short-term sort of days to weeks. And if you look at what the market tends to do, it tends to mean revert. So in general, you want to be buying weakness and selling strength. On the medium term, which would be, I would think, a couple months to a couple years, the market actually tends to perpetuate, tends to follow trends. So you're better off buying strength and selling weakness over that time frame. Over the long term, if you think of the business cycle, things tend to go back to mean revert. So cycles, sectors and groups come in and out of favor. Now you look at the bottom, the use of fundamental analysis, or I think what you should think about. So on the short term, you really don't need a ton of fundamental work because the markets are much more driven on investor behavior and fear and greed. But on the long term, stocks tend to trade to their fundamental stories and themes. So you want to use more on that side of the equation. So thinking of those different timeframes, let's look again at the chart of IAC, and now we'll start to understand how that works. So again, on the short term, if you look at the oversold condition on the right, good entry point for IAC because it had come down so quickly. But now we're bumping back to the last couple years, still looking at daily data, but expanding the time frame a little bit. Now you can see that this chart has really three different periods. So in 2015 through about February of 2016, we're in a bear phase, lower lows, lower highs, and you can see that the RSI frequently became oversold, never really got above the 60 level. And that range, if you've read Connie Brown's work, she introduced me to this when I was studying for the CMT exams. I read that whole theory of it in a bull or bear phase, you want to adjust the overbought and oversold levels. If you look at after the market bottomed here in February, as IAC has rallied over the last couple of years, you can see that the RSI went back into a bullish configuration. So it became overbought frequently, never became oversold, and the RSI really never or rarely went below 40. What concerns me now, if you put this oversold condition into context, is we're now getting back down to that sort of traditional bearish range like we saw back here in 2015, where the RSI frequently gets below 30, it rarely gets above 60. Now, that remains to be seen. This is not saying that this chart alone tells you that IAC is in a bear phase now, but it's showing the signs that it may be starting to enter that. So what I would do with this chart is see if IAC continues to recover, how far does the RSI get, and does it get into the overbought condition, which might tell me that the uptrend may be continuing. But if it stays down in this sort of 20, 30 to 50, 60 range, that just suggests to me that we're in a new phase here. We've transitioned from a bullish to bearish phase. So in this time frame, looking at these couple years, we want to be more trend followers. We want to understand when the overall trend is changing, and then find that overall path of the trend for multiple years. Now, what's interesting, and it's funny, why does herding exist? Why do people pile into one side of the trade or other? And in a stock like Facebook, how and why do trends persist for multiple years, right? And I would say this, having spent a lot of time with institutional money managers, people running, multi-billion-dollar mutual funds, you will find that, overall, broadly speaking, if you think of a technical perspective, they tend to be trend followers because they tend to be a little bit longer term, multiple months to multiple years. So following trends is the right answer for most of them in that time frame. What happens if you're a money manager? Let's assume you run a $20 billion mutual fund. You're benchmarked to the S&P 500, so your job is to outperform that basket of stocks, that index. And you have a stock like Facebook, and in 2014, 2015, the stock continues to go higher highs and higher lows. If you look at the relative performance of Facebook to the S&P, you can see it continues to outperform. The problem, if you don't own Facebook at this point, is you have to go around to all of your clients and justify why you don't own a stock that is outperforming your index. This is a stock in your benchmark. It is a pretty big weighting. It's one of the top 5 in terms of market cap. At this point, I would say Facebook's probably 2% of the S&P, which is one of the largest names. So if you don't own this, it's really hard to outperform. And that's why a lot of institutional money managers have had to be in the FANG trade, because these are big names that are outperforming and you have to be in them. Otherwise, the hurdles to outperforming are just too great to overcome, even if you have a lot of small cap stocks that are doing well. So what happens is, as we all face this career risk as institutional money managers, we start to think, all right, I have to be in Facebook, I have to be in Netflix, Amazon, these names that are doing so well. What happens when $20 billion fund managers go into a stock like Facebook? That provides more and more demand. That takes supply off the market. That pushes the stock higher. And that's why trends tend to perpetuate over the multiple year cycle. What's interesting now is, if you think about some of the FANG stocks, and that's what we'll look at just to wrap up my portion of the presentation today, is that, arguably, if this FANG trade would unwind, or if some of these stocks would not tend to be leadership in the coming months and years, that would be a huge change and would open the door for a lot of mid-cap, small-cap names to have a real opportunity to, to generate alpha, to generate outperformance. And I think as stock pickers, it could be a really good opportunity if and when that trade would roll off. Looking at the short-term chart of Facebook, what I would consider short-term, it's just looking at daily data for the last 6 to 12 months. We can see that the challenge with a stock like Facebook right now is we've entered what I'd call a supply area. This is where sellers have tended to take profits. This is where, if you're in a long position, you tend to get out. This is where shorts arguably have maybe entered. But for some reason, this price range that we're in is where Facebook has found a top a number of times over the last 6 months. So number one, that concerns me. And unless we break out of that range to the upside, ideally on higher volume, it tells me that it's just not quite there, and that Facebook isn't the leadership yet that we would need to propel us out of this consolidation in the equity markets. RSI, if you look, I've just put a simple trend line looking at the uptrend in the RSI. I'm watching that closely to see if that would break down. It has not yet, which tells you, after the data issues and Zuckerberg's testimonies, the stock has recovered very, very nicely. But we'll see if and when that would break. That would be a concern. The one concern I see otherwise is the MACD indicator, which is a simple trend following device, relatively short term in this case, really, really close or right at a potential sell signal. So that's another thing I would pay attention to. Another chart to think about, Google, just thinking of the other large, sort of tech consumer names in the FANG trade. I wrote a piece on the Top Advisors corner on StockCharts.com end of last year, looking at stocks like Google, Amazon, Apple. These are all stocks that have had this phenomenon. They hit big round numbers, and then they tend to reverse. So Google, coming up to 1,000, hit resistance all through last year. Once it finally broke out, it has tested the 1,000 level a number of times. So the fact that Google's recovered a little bit, that's good. But overall, we're still putting in sort of a lower high. And that is a great opportunity anytime the stock gets back down to that 1,000 level to look at it as a potential, short-term buy. If and when it would break that would be pretty negative for the stock. But we're not seeing any sign of that now. But looking at Google, that's the level that I would pay attention to on the downside for sure. And then finally, a chart like Netflix, if you compare this chart to the last two we've looked at, Google and Facebook, you can see why Netflix and Amazon have been the real leadership within those large mega cap names, because it's almost at new highs, very close to breaking out. The RSI is nowhere near overbought, so it still has some upside according to that momentum read. The only concern here is we had this bearish divergence with higher highs and lower peaks in the RSI, but overall it's been very resilient and has held up well. So you compare this chart to the last two, and you'll see why Netflix and Amazon out of that FANG group have really been the leadership, and those are the ones you would look to see if they would break to new highs. I just wrap up my comments. Tom mentioned the dollar earlier, and I think that's a fascinating story. If you think of the weakness in the dollar that we saw up until the last couple months, where we've seen this beautiful rotation, and now I've seen a period of higher highs. I wrote a piece about a month ago on Top Advisors Corner, looking at this breakout on the weekly chart and lining up some Fibonacci levels on the daily chart. What's interesting is we've now actually hit all those objectives that we talked about. So in the next day or two, I'll be posting a follow-up article, sort of looking at updated charts on the dollar and what to do now. Now that we've reached those objectives, where do you sort of look? And overall, the quick answer to that is I think anytime I'm questioning, I go back to the mental checklist, and the very first thing on my checklist is Dow theory. Are we seeing a pattern of higher highs and higher lows, or lower lows and lower highs? And with the dollar, if you look at the chart, it's pretty simple to answer that question. We're seeing a pattern now of higher highs and higher lows. The trend is higher until we see some sort of evidence to the contrary. So thanks. I hope this was an interesting look at herding and some of the ways that that manifests on charts and how to think about an indicator like RSI to help you get ahead of some of that. And at this point, I'll pass it back to Tom and Aaron.
Hey, I know I have some questions for you from the chat room that I think are valuable to the discussion based on what we've been talking about. But one of them is about the RSI and the fact that, if it doesn't reach 70 and it's going up and down, do you consider that consolidating? To add on to that, I know for me is if you've got that the RSI pretty much standing above that 50 and moving up and down, not getting past 70, I would look at it more as there's still some internal strength there. But if it starts oscillating below the 50 area, it'd be more like an internal weakness setup. So what do you think about that?
That's a great question. And I think you're absolutely right. The overall levels of RSI and where you find the reversals of it, I think can be really instructive in terms of what a stock is doing. And at a time when, if we look at an individual stock, it's very easy to put the blinders on and just look at that. But as an equity investor, you really want to understand how this chart and this stock compares to anything else that you could be looking at. And a lot of times we're just looking at the wrong chart. Good analysis, but there are better charts, better actionable opportunities out there. So I think with RSI, if you look at IAC right now, the RSI is right at 50, right just above it, which, by definition tells you we're pretty much right in the middle of the range. There's an absence of real overall momentum overall. The fact that it's improving tells you something about what's happened recently as it's come off the 200-day. But if you look at a bunch of stocks and you look at which ones have an RSI, in the 60 to 70 range or above 70, or the 30 to 40 range below 30, that'll start to help you understand, by bucketing stocks, which names are at which points in their short-term cycle. But I would say you're right. And I mentioned with one of the stocks, or I think it was, and with Netflix, if you look at what's encouraging to me is even though the stock is in an uptrend, even though it's near previous highs, the fact that the RSI hasn't gotten to the overbought condition to me tells you that this is kind of a healthy uptrend. When it's in the 50 to 70 range, not really becoming overbought, but not getting anywhere in the sort of negative territory. That's a stock hopefully is a core holding that you can then build off of. But overall, I think you're absolutely right. The ranges can be really, really informative, especially when you're trying to compare different stocks and different charts.
All righty, let's see. Also had a question. So which do you actually rely on more? The earnings, past and forward, or the valuation ratios like P/E, that sort of thing, when you're deciding which charts to follow? Right?
Great question. And I would tell you this. So your question in some ways actually, I think, justifies charts to a great degree. And if you think about it, based on any work that I've done or that I've seen over the long term, over time, price tends to follow earnings. And if you just think of a chart of the S&P 500 and think of the overall earnings strength of S&P companies, they've been in pretty consistent uptrends over decades, right? So over time, stocks trade to the earnings. If you're in stocks that are, continuing to grow earnings, overall, you're going to be in a pretty good place. The problem is that is not a direct one-to-one relationship. The correlation is not 100% by any means, right? And what I mean is there are times when the best performing stocks are not the top earners, and there are times when stocks with less than ideal earnings can be top performers. And so using a combination of the two can be very helpful. In answer to your question, what would I use? I mean, I tend to look at valuations on a pretty simplistic basis because I don't use it as a decision point. I use it as a way to screen. So if I'm looking for stocks that overall are undervalued, I'd look at something like a PE or price to book, depending on what industry you're looking at. But for me, the main thing is the chart, because the chart is going to reflect how the stock overall is trading to the earnings. So again, stocks that tend to grow earnings over time tend to do well, but the chart is what's going to tell you whether whether or not this is the time to make that bet or whether you want to wait.
All right. And then I think you kind of went over this, but what indicators do you look at to check if the herd has tipped the boat over?
I like that. Yeah. I mean, there's a number of things. RSI is what I've used just as an example here. For me, I like to use things that are standardized. So something like, if you're more statistically minded, anything that's like a Z-score where you're standardizing the data across different stocks. The problem with something like MACD or things like that is, different stocks will have very different values, so it's very difficult to use that to compare a big group of names. But if you look at something like RSI, it's very easy to find. And a frequent screen I do is look at stocks with an RSI above 70, stocks with an RSI below 30. I do the same thing with industry groups. So on StockCharts, we've got the Dow industry groups, which is a great list of industries to follow. You can look at, put a list of those with the RSIs on there, and you'll very quickly see what's the leadership and what's struggling. So I think that's one of the best ways to do it. But also remember, another one that we haven't talked about, but you might see with the chart of Netflix we're looking at, is the distance of a stock's price from its moving average. So just the percent above or below the moving average. If you look at how far Netflix got above its 200-day moving average at the end of the first quarter, that was telling you, look how far away it was from the trend, assuming that the 200-day moving average is sort of the average sort of long-term trend. We got really extended from that. And all of that, the only way that's going to happen mathematically is if the stock is at a certain trajectory and then that accelerates, right? Because the 200-day average is an average of the prices, and all of a sudden we're getting further away from that. So another way that we haven't talked about that I would look at is stocks that are really far above and below their 200-day moving average. And again, that's not a trading system. That just shows you the menu, and then you need to look through the menu to decide what dish you want to order.
All right.
Hey,
yeah, there were a couple of others, but they were a little bit more defined towards stocks. Or if you do have time, though, we'd kind of be interested in your outlook for oil.
Interesting. Okay. Let me bring up a chart here.
And then, Tom, I'll let you get your questions in because I think I've exhausted the chat room pretty well.
So great question. On oil, again, I in some ways, my toolkit is so simplistic. And for me, I like to start with the basics, which is Dow theory. And I have a checklist, not to jump ahead, but thinking of the conference ChartCon coming up in a couple months, I'll be doing a session talking about mindfulness and investing. And one of the things we'll talk about is just having a really good checklist, which is a disciplined way of looking at a chart and deciding what it's telling you. And for me, the very first thing is, are we in an uptrend or a downtrend based on the traditional definition of higher highs and higher lows? There is no denying based on that analysis that oil has been in an uptrend. Looking at I'll look at a weekly chart just to start with here. This is the transition we've had in oil. This is the USO. So, not a great proxy because there's some issues in terms of how it's constructed, but overall gives you a good sense of the shape of it. The sell-off that we saw in oil and in the greater commodities space, this sideways pattern that we've had, and this uptrend. One of the things that I thought, as oil really got lower, was a reminder to everyone that once oil is done going down, that doesn't mean oil is just going to go up. That remember, just like we're seeing with stocks now, a market can go sideways much, much longer than we're comfortable with. And that was sort of what I was thinking with oil. Once we sold off, there was no real catalyst telling you it has to go higher. It could go sideways. And that's really what's happened, for the next 18, 20 odd months. But now we've seen a lot of signals that that's changing. And it's not just an oil story. You're seeing it with commodities in general. I think there's been a huge shift of weaker to sideways commodities and now to stronger commodities. Oil, I think, is in an uptrend. And I think in terms of upsides, there's a lot of space on this chart. There's not a lot of resistance that we would bump into for a little while, which tells me that there's room to go. If there's a concern, again, for those of you that are more short-term traders, we've been talking about RSI this whole session, and it recently became overbought. It's looking at the USO, but different ETFs and looking at crude, you've seen it become a little bit extended. So, could you expect short-term weakness? Absolutely. But overall, I think that's an opportunity to get in at a weaker price. The trend is higher and appears to continue to be so.
All right.
David, I know we got maybe just another minute or so, but I wanted to just pull up a chart real quick. And this is a chart. The main line, the black and red line, is the chart of the dollar. And you can see the dollar here over the past month, month and a half, 2 months has really started to move to the upside. And the pink line shows how the Russell 2000 performs relative to the S&P 500. And you can see that normally when the dollar's declining, money rotates more toward the S&P. Now we've got the dollar really moving to the upside. You can see small caps outperforming. Our poll that we've gone over is, or that's up in the room, is whether or not, you know, which area of the market does everyone believe is going to lead the next 3 to 6 months. And I think earlier in your presentation, you indicated that the dollar is in an uptrend as long as it's in an uptrend. So I guess looking at this chart, do you have any thoughts looking out 3 to 6 months, which area of the market you would, you know, most likely be invested in? I mean, are you looking more at small caps, or are you still sticking more with the larger cap stocks on the S&P or even the Dow?
A great question. And I would say, yeah, the dollar story, I think, is dollar strength until we see something otherwise. And as you've shown, that tends to be good for some of the smaller companies, less than multinationals. And that's exactly what we're seeing, right? If you know, for me, I like to look at, you know, comparing where we're at relative to previous highs and lows. If you think of the January peak in the U.S. markets and look at, you know, small cap, micro cap stocks, they're up about 2.5 or 3% above their highs. Right? They've already broken to new highs and have led on the way up. Mid cap stocks are about 2.5% below that high. And the S&P has been the worst. It's down about 5.2 or 5.3%. So, you know, in terms of what's happened, small micro caps have led. The larger and large and mid cap names have struggled a little bit on a relative basis, and I think that's a story that will evolve over the rest of this year. You know, if I had to make, you know, if I was answering the poll question, I'd probably pick small caps as the leadership to pay attention to. And again, the FANG trade has been so strong, and I don't see any of the FANG stocks looking horrible. They're going to be okay, but I think as the FANG stocks sort of fluctuate and stay in a general range, there are a lot of smaller names that are going to do much, much better. And that's where an opportunity is going to be. So that trend of small cap outperformance, dollar strength, and relative weakness from the large mega cap names, I think that's a theme that continues for the rest of the year here.
Yeah, it sounds good. I know my chart's not up there right now, but I did notice that in each of the past 2 or 3 significant changes in the dollar, the Russell 2000 versus the S&P 500 actually started reversing its trend before the dollar did. So one of the things I'm looking at is to see if money begins rotating back to the S&P 500, then that could be a signal that maybe the dollar has run too far. But until we see that, it looks to me like small caps are kind of ruling the roost here. And I would be, in terms of answering that poll, I would agree with the majority here that the Russell 2000 leads over the next 3 to 6 months.
Yeah, and just to bring it back to one of my earlier points, I think the challenge with that environment, assuming that is what happens, is it's something that many of us are not familiar with. And if we are familiar with it, it hasn't been the case recently, right? We've had this situation with, you know, mega caps being leadership way more than this poll would suggest. And so that I think that's a reminder to everyone to stay true, stay disciplined to your process, and watch where the leadership is. Don't assume it's going to be a certain way just because it has been before. The charts are going to tell you where the leadership is. And again, based on what I'm seeing, I think small cap is where we'll start to see that more and more.
All right. Sounds good. Well, as usual, great having you on the show. Another great presentation. Look to have you back on here pretty soon, my friend.
It's a pleasure. It's always great to talk to you, and thanks so much.
Volatility is back, interest rates are rising, and the markets are headed into uncharted waters. As uncertainty grows and the tides begin to change, you need to take action. ChartCon 2018 is here just in time, with an all-star cast of investing experts and industry-leading technicians. Watch live as these pros share their charting wisdom and guide you through their strategies for finding success in any market. Your registration includes 2 days of insightful, exclusive presentations from 15 investing legends, plus complete video recordings to watch on demand for years to come. Stream ChartCon live right from the comfort of your own home or office. No need to travel, no need to break the bank. See how the experts are protecting themselves from market volatility and reducing risk in today's uncharted waters. Join us at ChartCon 2018, streaming live August 10th and 11th.
So in the book itself, just so everybody knows, it's all StockCharts charts. It's all StockCharts setups. But I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in StockCharts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody.
Hi, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. Today we're going to show you how the market summary page works. Here are the topics and the timeline for today. First, we'll show you where you can access the market summary page. Then we'll go over the different parts of the market summary page. We'll show you the different viewing options, intraday, ETF, or combined. We'll show you how easy it is to add and remove columns to customize the page. Then we'll show you how you can sort by one or more columns. And finally, we'll give an example of using the search box. Accessing the market summary. There are a couple of ways to access the market summary page. I'm here on the free charts page, and you can see with that drop-down menu at the right, I have a link for free charts. And if you open up the browser, then you will get links up at the top for the main sections here at StockCharts. And on the right side of this free charts page, you have the summary pages, and there is a link for the market summary page. You can also access the market summary by clicking on the members link. And when you go to that page, you'll see the control center. And if you scroll down on the control center, you will see a selection for reports and analysis tools. And there you can click the market summary link. Parts of the market summary. The market summary page was designed by John Murphy, and it is specially designed to give you a quick impression of the major market averages and common indexes during a typical trading day or end of day, depending on how you like it. It's really handy. I find myself checking it throughout the day. Now, it's laid out in a top-down format. So you can see you've got the major markets at the top. Then you have the major indexes. So you can see how large caps, small caps, the Dow Transports are performing. Then we go down into the sectors and then into the industry groups. So here you have one glance and you can see all the industry groups and see which are leading and which are lagging. Then we have the international ETFs. We have U.S. bonds in the form of Treasury yields, and we have U.S. commodities, and these are ETFs, so you can track the intraday action. Finally, we have currencies and market breadth, and there are a couple of links at the bottom where you can click to get the end-of-day summary page and the McClellan Oscillator and Summation Index for the NYSE and NASDAQ. At the top and in the middle, you will see Market Summary 4, and there is a drop-down menu for selecting the different viewing options. On the left-hand side, you will see a column button, and you can click on that button to add or remove columns. Just below, you have different icons, and those are links for different charts for that particular line. Here it is the Dow Industrials. And you can see the name is also linked, so you can click on that for a sharp chart. Each of the column headings are displayed, and you can click on these headings to sort by that particular heading. And on the far right, we have the date and the time and a search box if you want to search the market summary. Now let's review the different viewing options. Chartists can use the drop-down menu at the top and in the middle to change the viewing option. You have intraday, end-of-day ETF, or combined, which is of course ETFs and indexes combined. Now I'm not going to show you all the details and the differences. I recommend you look at these different viewing options to see which one works best for you. For now, I'm just going to highlight some of the main differences between intraday, end-of-day, and ETF. The first two differences would be with bonds and commodities. Here on the intraday market summary, you can see we have a handful of treasury yields and we're using ETFs for commodities. And if you look at the end of day version of the market summary, you can see we're using treasury note and treasury bill prices because these are end of day prices, so you're getting the actual treasury bond. And if you look at the commodities, we're using continuous futures, and these are updated at the end of the day. Another area that has a significant difference would be in the market breadth indicators that are shown. Here on the intraday market summary, we have tick, trend, the McClellan oscillator, and the volatility index. If you go to the end of day market summary and scroll to the bottom, towards the bottom, you will see an array of market breadth indicators. And we also have the bullish percent indices for you to follow. Now, both the intraday and end of day market summary pages show you the international ETFs you see here on the left. The end of day market summary page adds the major world indexes. So if you want to follow the German DAX or the FTSE, they're going to be on that page. If you're just interested in ETFs, then you can simply select ETF here. And now I've got just ETFs for the major indexes, the sector SPDRs, the industry indexes are now ETFs, international ETFs, the bond ETFs, commodity ETFs, currency ETFs, and the VIX ETF. And this is great for getting a quick overview throughout the day and at the end of the day of how the market is performing. Adding and removing columns. Chartists can easily add and remove columns by clicking the column button, and there you will see all the columns that are currently selected. So if I don't need the closing price or the name, I can click those and they will be removed. So now I just have the symbol and the change. If you want to add those back, you just click them again to add them. Sorting by one or more columns. I'm here on the bullish percent indices, and if I want to sort these, I will click the percentage change heading, and I can reverse that sort by clicking it again. You notice I have all these zero values. If I want to do a second sort on top of this first sort, I'll hold down the Shift key and click on the column heading for the second sort. So here I'll hold down the Shift, click on Close, and you can see now I've sorted within these zero values by the closing value. Using the search box. And finally, if you want to search for a particular word on the market summary, go into the search box at the top right. I'll search for gold, and you can see that three things pop up. I have a U.S. industry index, I have a U.S. commodity, and I have a bullish percent index. And that concludes this instructional video on the market summary page. Thanks for tuning in, and be sure to check out our other instructional videos.